Hello and welcome to Season 4 of Simply Safe, the personal finance podcast by Moneycontrol, brought to you by Kuvera.in, India's first completely free mutual fund investing platform. You are listening to Lisa Pallavi Barbora, and joining me for this episode is Kayezad Adajania, the personal finance editor at Moneycontrol.com. Hi Kayezad, welcome to this episode of Simply Safe.
Hi Lisa.
So Kayezad, we are discussing an all-important aspect of investing today. It's not returns, which is what everyone likes to focus on. Rather, it's about risk.
Okay.
A discussion which often gets missed out.
Correct.
And we are going to start with the simple mutual fund disclaimer, which is very well known, and I'm going to use it as well at the end of this podcast. When we say market risk in that disclaimer, what does it mean in simple terms?
Simple terms?
Yes.
NAV goes up and NAV goes down.
Okay.
Right. So, when you invest in a fixed deposit, you can calculate right at the start of your investment that this is the amount that I have invested, this is the interest that I am going to get, no matter what. Your NPA levels may shoot up, economy may go down, come up, governments can change, anything can happen. You know that interest is going to hit your bank account at the end of every quarter or every month. Okay, so in a mutual fund, NAV can go up, NAV can go down. Okay, you have equity funds, you have debt funds, there is market volatility. So tomorrow something happens in the market, so something happens in the economy, and it has an adverse impact on the markets. Markets go down, there are big headlines in the newspapers. I'm sure all of us panic or rather glare at it when it comes. That actually is risk, because it hits your equity funds, it hits your debt funds. The NAVs go up, the NAVs go down. But of course, this is all in the short run. Okay, in the long run, statistics have shown that the chances of you losing money actually goes down. Okay, volatility remains, but it's more to be seen in the short run, but it kind of evens out in the long run.
So the market risk we are talking about is really volatility, because these securities, whether in equity or fixed income like debt, they are what we say listed in the market.
Correct.
And hence they have a market price, and depending on how much demand there is to buy them or sell them, that market price can change every day. But in the long run, the price adjusts to fundamentals. Is that how one is to understand?
Price adjusts to fundamentals, and more sense sets in. Okay, in the sense that you know that the company, if the company is a well-managed company, eventually markets would understand. Okay, but in the short run, if suppose there is a shock in the market, or if there is a shock in some economic policy, then obviously your stock price gets impacted in the short run. But eventually, company earnings, when people see company earnings, the stocks settle down, and your mutual funds also settle down over a long period of time if you stay invested. Of course, there's market risk, but there's a way to sort of overcome your market risk also.
So before that, other than this risk of daily price change, as you put it, volatility, which is thanks to an inherent kind of demand-supply mechanism in the asset markets, are there other risks that investors need to be aware of?
So there's credit risk. In the case of debt funds, in the case of debt funds, there is also interest rate risk.
Right.
So what happens is that, if your company invests, if your mutual fund rather invests in a company, and we're assuming that the fund manager would have done his or her due diligence and invested in a well-managed company with a high or a higher credit rating. But what happens is that, what happens tomorrow if there's a problem in the company? Okay, and the credit rating goes down. If the credit rating goes down, the bond price of that instrument also goes down. It impacts, and therefore your debt fund also gets impacted.
Right.
So credit risk is very much a risk in debt funds.
And can it also affect the repayment of the security to the mutual fund? Because if they bought a bond, then they're hoping for an interest payout from the bond.
If there is a delay in the interest, then yes, there is a temporary gap. If there is a default, in the sense that if the company goes belly up or some liquidation problem happens, liquidity problem happens, then obviously it impacts your debt funds. Okay, and if the payment doesn't come in time, then obviously as per norms, debt funds have to take cognizance of that, and that impacts your NAV. So obviously credit risk is there. It may be there in let's say more in credit risk funds and less in, let's say, corporate funds or corporate bond funds or banking PSU funds, but nevertheless it's inherent to debt funds. Interest rate risk, definitely that's also a risk, because when the interest rates in the economy go up and down, your bond prices also move in the opposite direction. So that's something that your debt funds face day in and day out. And then of course there are other changes also, like what happens if you invest in a mutual fund today thinking that this is a good fund, it's done well over a period of time, the fund manager has been around, but let's say 1 year or 2 years down the line your fund manager leaves,
Yeah.
Okay, so
That's a risk.
that's a risk.
Right.
Exactly. And
Yeah.
a new fund manager comes, and he or she may not be as I would say may not have an impeccable track record, or may not
have
be
a
able to
different
replicate
style, maybe,
different
which
style.
affects
Exactly.
the fund returns differently.
Portfolios change, strategies could change after, so that also is a risk.
Okay, and in recent times, you were talking about credit risk just now. In recent times, with what has happened on the debt fund side, companies have defaulted on bond payments, and that has impacted the return that an investor gets from certain debt funds. On the equity side too, we are seeing, there are stocks like Yes Bank where fund managers were bullish at one time, but that stock has plummeted. And we know that even experienced fund managers then can get caught on the wrong foot.
Many times.
How can investors safeguard their portfolios against what we can call, certain natural calamities that happen in the markets?
So, two things. One is that obviously, you need to diversify. You just cannot put all your money in just one fund. Okay? Because what happens is that if something goes wrong with that one fund, your entire money, your corpus, entire thing gets kind of linked to that fall. Okay, but if you have invested or spread your risks across funds, then suppose if something happens with one fund, at least your other 4 or 5 funds are there to sort of safeguard your portfolio from a free fall. Okay, so diversification is one very important aspect. The other thing is obviously you have to diversification not just in terms of funds, like diversification in terms of asset classes also, which is what we call as asset allocation. Okay, it's a very repeated word, it's a cliche word if you listen to mutual fund commentary, asset allocation, but it actually makes a lot of sense, because if you debt behaves in a certain way, it walks in a certain way, equity runs in a certain way. Okay, so you can't just invest all your money in debt fund and go at a snail's pace, or you just can't go all out and put everything in equity funds and hope to run a race. So you need to spread between equity, you need to spread between debt, and also a little bit of gold, so that sometimes what happens is that equity markets are very volatile, but you find solace, let's say, in liquid funds or in short-term bond funds, or maybe in gold. So asset allocation and diversification actually helps you to reduce a lot of risk.
So diversification across the individual funds, and before that perhaps the asset allocation across different asset classes.
Correct.
They say asset allocation gives you maybe 80% of what return you seek.
Correct.
And that can help an investor. So diversification then becomes a structural part of an investor's portfolio, and that's how they can perhaps manage the market risk in a sense.
Correct.
However, I find that the biggest risk that investors face in case of market-linked securities is perhaps their own behavior, because there's so much that happens in markets. So would you agree, and what can one do then to protect oneself against this risk?
Yeah, so funny that you said earlier that 80% of the returns come from asset allocation and diversification. So Lisa, when I talk to financial planners, they say that 80% of the time that they have to spend with the customers is trying to channelize their behavior, trying to sober them down.
So investing is about behavior management.
Yes, and just 20% of the time goes into actually doing research or servicing them as such. So yeah, I mean, behavior is a huge part of your wealth creation. It has an impact on your wealth, it has an impact on the way you manage your finances and what you make out of your money. Okay, so you need to be simple things. I mean, you need to be disciplined. Okay, don't go, you don't need to be a millionaire to sort of be investing. If you can just set aside, have the discipline to set aside 1,000 rupees or 5,000 rupees every month, regular investing. So that discipline itself is enough to take you through to a long time. Okay, we've seen a lot of panic set in among investor community in the last 3 or 4 years because of the way the markets have behaved. And would you believe it, when these direct plans are being sold to investors, there are a lot of people who have come into direct plans thinking that they'll save cost and they'll make more money, okay, just by saving costs. But in direct plans, at many times I've seen that people get lost because there's nobody to handhold them. So
nobody to manage the behavior.
So I mean, people like you and me can invest in direct plans and get away with it, okay, but the common investor needs a helping hand, needs a guiding hand. So part of your risk management is also you need to be constantly engaging with your advisor, financial advisor, financial distributor. Engage with him or her, keep talking to him, try and understand what's happening in the market, so rather than just pressing the panic button and getting out. So behavior is a very important aspect. I can't stress enough on that.
Yeah, absolutely. One has to manage that. So I think it's fair to summarize and say that asset allocation and diversification are one's biggest tools to combat market risk. And unless you can manage your own behavior, you will run the risk of mismanaging your investments. Yeah. Okay, Kayezad, thank you so much for talking to us on this important aspect of investing. Thank you, listeners, for staying tuned into this episode of Simply Safe podcast. Remember, mutual fund investments are subject to market risks. You must read all scheme documents carefully before investing. Do your homework, and if you have any queries, you can write into mcpodcast@nw18.com. That's mcpodcast@nw18.com. For more views, news, and updates, stay logged on to moneycontrol.com. Thank you.